Chat with Traders, episode 136.
This is your key to the minds of trading's elite performers, those who profit in relentless markets. Here on the Chat with Traders podcast, you'll hear about the skill sets and tactics that lead winning traders to win, so you can level up and become a better trader. Here's your host, Aaron Fifield.
What's up, everyone? I hope you're doing just fine. Thanks for tuning in. I'm Aaron Fifield, and I'm pumped to share this episode with you. And I also have something I'm pretty excited to tell you about. So let's tackle that first. I've just released a full range of Chat with Traders merchandise, and it's available right now at chatwithtraders.com/shop, SHOP. There's currently 5 designs. They're available as t-shirts and also sweatshirts in all sorts of colors. And something I'd love to mention is I worked with a brilliant designer on these, someone who has previously designed merch for some really major bands. Bands you've probably heard of, like Goldfinger, Fall Out Boy, Silverstein. So I'm really pleased with how they've turned out. Please stop by the shop, check them out, and help to support this free podcast, chatwithtraders.com/shop, SHOP. Right, now on to my guest of this episode, Mike Agne. So there's probably going to be roughly 100 listeners who are already very familiar with Mike, and that's because he's the trader who I did the live podcast with at the Chat with Traders event in New York City in May. So if you're one of these people, there may be a few moments of déjà vu while you're listening, but for everyone else, Mike came into trading approximately 20 years ago. He started at Chicago prop firm TransMarket Group, which of course was founded by legendary trader Ray Kahneman, and that's where Mike spent a total of 12 years of his career. And over the course of his time there, he actually became one of their largest 30-year Treasury basis traders, both in terms of volume and performance. And if anyone recalls Trader Monthly magazine, Mike was named one of the top 30 traders under 30 in 2005, which is certainly a noteworthy achievement. Nowadays, Mike is trading his own book and building out a track record with the aim of launching a hedge fund in the coming years. But you'll hear more about all of this, the things which have helped Mike get to where he is now, and how he trades bonds using a relative value strategy during this episode. Though just before we start, I do need to read out a very short disclaimer for compliance reasons, as Mike is affiliated with DV Trading. So please note that while Mike is a trader within a group at DV Trading, the views he expresses here are his own and do not reflect the views or opinions of the firm. Mike does not represent DV Trading in any capacity. All right, with that out of the way now, here is my guest, ladies and gents, Mike Agne, coming at you from Chicago. Yeah, anyway, I'm sure we'll get to that in the podcast.
Yeah, I listened to your one just real quick on the your BTC VIX guy. I like that guy.
Yeah, okay. I know you've got I know you've written about Bitcoin a couple of times, haven't you?
Yeah. I've been trying to at least get some exposure to the people out there that don't have it, but are going to hear about it and start to question it, because it's, ever since it seems like Mt. Gox gave it a bad name, and I got burned in that too. But on any new innovation, you're going to have the bad actors, and you just got to weed them out.
Okay, so you have traded Bitcoin previously, have you? Or you owned some?
Yeah, I've been trading it. Yeah, probably for like 2 years at least.
Oh, I had no idea. Okay.
Yeah. I've been talking about it since like 2011, and people, everybody I talk to, everyone's a main like equity bond. They don't like to deviate off into the dark web like Bitcoins. And then I always try to explain it to them, like, you guys have no idea what you're talking about. Blockchain technology, that's going to take over, and Bitcoin is like the first out of the gate, and it's the token basically for blockchain. There's other, Ethereum and Litecoin, all those too, but but Bitcoin's the one that's made it out of the gate and has made it through, this whole time up and down. So, I think it only got upside, but I think people generally don't understand the technology, and that's what deters them from wanting to even get involved. So, people are afraid of the unknown,
Yeah. I mean, I guess I kind of fall into that category of not fully understanding the technology, like what exactly the blockchain is.
Yeah.
It's
well, you did
complex.
a good job on that interview. Yeah, no, he was very good in explaining it like in general terms. So yeah, I appreciated that one. That was a good one.
Yeah, no, he's really great, and I'm sure he'll be on again at some point. It's a constantly evolving marketplace, that's for sure. And I think
for
things
sure
are just getting warmed up.
Yeah, no, exactly. And now you got Goldman Sachs covering it too. So that's interesting in of itself.
For sure. Now, Mike, to you 20 years ago, what actually got you into trading? What piqued your interest?
So let's go back a little bit further, back to my childhood. So I was the youngest of 8 children. I had 5 older brothers. So there were a lot of learning lessons built into that. And one of the advantages was that I was introduced to like real world things at a young age, some good, some bad. But one of those things were financial futures markets. One of my brothers worked on the CME trading floor as an ARB clerk, and a few of his friends did as well. So I was exposed at a pretty early age to that arena. My brother would leave these futures magazines laying around the house, and so I would look through them, and it really sparked my interest. I can't tell you what inside there did, or if it was the graphs or the, all that cool stuff. I can't really say for sure, but they basically told me, when I asked my brothers, like, what was all this stuff, was, well, if you could guess the price of something in the future, then you can make money. Obviously it's a bit more complicated than that, but to a 12-year-old kid, it was enough to pique my interest. It was like magic, and I loved magic, so it kind of reminded me of that. Yeah, so that was kind of my first real exposure, I think, at that early, I was probably 12 or 13. And then I can remember looking through like the Sun-Times Chicago newspaper here and going to the T-bills section where they used to list them in there. And I think they actually still do now, but, and then try to check back a week later to see if I would guess the price right, if it was higher or lower or whatever. So I think that's, for one reason or another, that probably intrigued me early on.
Okay. And then how did you actually get involved in trading? Like, when did you actually start to commit some money to this?
Well, I got my first real shot at trading in 1996 when I took a phone clerk job at TransMarket Group, which is a prop firm here in Chicago. So I spent, a lot of my time first learning about the financial interest rate markets, the U.S. Treasuries, to be exact, and that was the area that I would be responsible for. So I was lucky to get the job there. I always wanted to get on the trading floor or get a job down there. And usually you had to start out as a runner or something like that, and then work your way up to phone clerk and then possibly broker or trader. But I interviewed for this phone clerk job, and they, reluctantly took me on. So that was my first exposure, was at TransMarket Group. And basically my job was to answer the phone and enter orders into the futures pits for our Treasury cash traders that were sitting up in an office.
Right. And how long did you do that for?
I was a phone clerk from, I think I started in March of 96 to the beginning of 98. And I worked for 2 separate cash traders. They traded the 3-year and the 5-year. That was their main trade. And so it got to the point for those guys where, and I was very fortunate to learn from these 2 individuals, Jeff Conrad and Mark St. Amand. They were very good traders. They knew the trade very well. They were very good at explaining it, all the, the new lingo that went involved with bond arbitrage and that. They didn't have a problem explaining their stuff to me, where, some guys like to hide their, their bread and butter, where these guys are basically, willing to, explain it to me so I got a better grasp and better understanding so I could do my job better. So that I really was, grateful for in the fact that they were willing to take time and make sure that I understood exactly what we were doing. And, obviously they benefited if I did well or got them a better fill. And so I did that for like a year and a half. And then it got to the point where I knew their trades so well that I would almost be telling them when to buy or sell because I would watch the floor guys. And, not that you can do it now, but back then on the trading floor, you had, locals and, which were, the traders, the speculators and the big bond and brokers. And you knew who everyone was. You knew who everyone covered, whether they covered Morgan Stanley or Goldman Sachs or JP Morgan, you knew which guys to watch. So a lot of time, even though the cash market generally led the way, the futures market sometimes would based upon whatever was going on. So I got to the point where I would lead these guys sometimes, hey, you better hit that cash or buy that cash up because the futures are going to go bid. And, so I made them a lot of extra money. So it got to the point, where I was like, hey, can you guys give me a shot at doing this? I understand this, maybe it's time. But I felt, I wasn't obligated to work for them at that point. I could trade because there was other guys doing this. They were trading and clerking. So that's basically what I wanted to do, but it took some time for them to kind of let me at least do that.
Okay. So at this point, you'd gone from being a phone clerk to now swapping over to becoming a trader, and you ditched the phone clerking role?
Yeah, you can only do that if you found someone else to take over your job and did it well enough as you did. It's kind of like a pecking order, right? So basically, I had a phone clerk during the day and I could trade at night. So I kind of had both jobs at once. So it taught me that I could sleep a lot less than I really needed to.
Well, I was going to ask you, how many hours were you working a day?
I would probably work, well, at that time they had night bonds. So you would work from basically 7 to 2. And then the night bonds would open, at 5 o'clock and then be open, I think, till 10 p.m. So you could work that session. You could work from 7 a.m. till 10 p.m. Or I think in 98, they came out with the Project A system, which was the CBOT, the Chicago Board of Trade's electronic system. And maybe it came out earlier, but I didn't have access to it. But then that allowed bonds to trade overnight on an electronic system, whereas the 5 to 9 p.m. session was still on the floor. So that was the trading floor. So basically, I would work, from 7 to 10 on some days, if that's what I wanted to do. And that was your kind of progression. TransMarket was very big on you cutting your teeth and, working as a clerk and then working your way up to a trader if you picked up the skill set enough to where, they felt that you could do it. That's kind of how Ray Common ran his operation there. And he was very, I think he took a lot of traders under his wing, and he was very good about that. But he was also, he was instrumental in, I think, probably not only my trading skill set there, but in a lot of guys growing up through the ranks through TransMarket. So, but I knew that was the order that I would have to take, and I knew that I would have to do both of those things, and that was kind of just expected.
Now, these two traders who really helped you and kind of molded you into the trader who you were early on, what were some of the big things that you picked up from working so closely with these guys? You were clerking for them. What were some of the things that, is there anything that stands out which they really tried to instill in you?
Yeah. I think this was kind of the balancing act because Mark and Jeff were very disciplined traders. I think, not only on what trades they would actually do, but, I think on the risk side of it, being risk averse and knowing when to take risk, when not to, and not just putting something on just to put it on. Whereas Ray Common was kind of more like a risk taker. So they were the balance between that little bug in my ear, Ray Common, and saying, hey, take the risk and let's see what you can do. And then these guys were more of the, I don't want to say conservative because it's very hard to be a trader and be conservative, but they were disciplined. And I think one of the main things that they installed in me was discipline of knowing that you could put this trade on and it might not go your way. So then it's up to you what you do with it from there. Do you add on? Do you take the loss? Do you, just get out and reconfigure it and see why it's not working out? I think they were very good at installing that early on for me. Just that discipline of those choices and when to take them. Timing is everything. So you may have the right trade on, but if you put it on at the wrong time, then then you got to figure out where you go from there. And I think they were very good at that, the timing piece, structuring the trades and why they were doing it. They had good rationale. I understood their trade. So, they would explain to me why they were putting something on, whether it be for like a repo play or a calendar roll play, something like that, which some guys in the industry, if you're not in the bond, market, you might not understand repo and that stuff, but that might be a topic for another day. But it's just stuff like that where on a bond arbitrage, as a bond arbitrage trader, you need to know those things, and learning from guys that can do it and do it well is I think highly advantageous for a young trader.
So you had quite an interesting path into actually becoming a trader. Like, you started out as a phone clerk and then you graduated to becoming a trader ultimately. So you kind of had a different path into this than, I guess, what most traders do, especially nowadays anyway.
Sure. Yeah.
Were there still challenges for you when you did begin trading full time? Because you said, towards the end there when you were clerking, that you were almost kind of guiding these guys on what trades to make and how to manage certain positions. But when it actually came to it and you were trading for yourself, still at TransMarket, of course, were there any challenges that you still came up against?
Yeah, sure. I think the biggest challenge was getting over that hump of trusting that you know how to do it and you can actually do it. I'm never going to forget the feeling in your stomach when you put something on and you don't, obviously you don't know it's going to go your way. It looks good, it feels good, but, it might not necessarily, go your way. And that's not for everybody. And I think that's what separates successful traders from guys that think that they can just do it, is the fact that you can handle certain types of risk and you don't jump the gun, or you don't, do something irrational where your mentality kind of, dictate your profitability, or your, you may lose money, or, because you make a silly decision because you let your mind take over instead of letting your rationality take over. So, but I'll never forget that feeling of putting like one of my first, trades on, because I was always worried about Ray Common coming over and saying, "Why'd you do that? What, especially if you were wrong, he loved you when you were right, but he really didn't like you if you were wrong." But that was part of how he did things. And I think it made you a better trader, because not only did he want you to put on risk and take the risk, but he wanted to see how you handled it. This isn't, that's why I don't really believe in paper trading, because it will never be able to supplant the real life experience of actually risking money and capital. And I think TransMarket was very instrumental in teaching that as well. They knew that it takes money to make money, and they know that not everybody's going to be a winner. But in order to find that winner, you have to take some risk and believe in some of these guys that come in. And I don't think your demographic or your background really mattered to any of these guys. It mattered whether or not, you could actually do it. And like I said, it's not for everybody. And I don't think many people like to take risk. I think a lot of people, take the safe route, and that's okay. And that might be for some people, but for some others, taking risks, I don't want to say it comes naturally, but it's just easier for some more than others.
Absolutely, yeah. How did you begin to build up your risk tolerance? I presume Ray was certainly a big influence on that, but I mean, can you kind of give us a bit of an idea on how you became, I don't know if more comfortable is the right word, but let's just run with it.
Yeah, no, I know exactly where you're going with it. And the simple answer is, you have to build up capital. He always said, having skin in the game will make you a better trader because you have something to lose at that point. Yeah, everybody can come into a prop group and trade their money and risk whatever and walk away and maybe get a job somewhere else if it doesn't work out. But if you go into this thing with that mentality, forget it. You'll never do well because you don't respect the capital. So that's one of the things Ray and TransMarket taught early on as well, is that you have to respect the capital, and you have to respect the fact that markets can stay irrational a lot longer than you can stay solvent. So that was one of their, key mantras there. And, I think it worked for me because it gave me the discipline, on the heels of, Mark and Jeff and what they taught me, to build up something before you actually take excessive risk, or maybe, move up in size, which you can make more money that way. Not only hold on to something longer, but you can create more alpha by adding on and building a bigger position. So, but the only way to do that is to, have successful runs and build capital up so that you can do that. I always felt more comfortable when I was doing well that I could put on more size. And that's really what turned the tide for me in trading, was that I got very comfortable putting on risk as I was making more and more money. And that might not be the progression for everybody, but for me, I felt that with the capital behind me and I knew my risk, that I was very comfortable. And I think being comfortable was one of those stepping stones of being a successful trader.
In the process of doing so, did you experience any kind of setbacks? Like, were there any like big hits that you did take by taking that path?
Yeah. I think one of my first early lessons going on the Project Day electronic system, and then for those that aren't familiar with this system, it was the Chicago Board of Trade's first fully electronic system where you could trade bond futures and in other futures that they had at the CBOT. But when I first got my shot at trading, and I was doing what was called 5-year basis, so I would buy and sell 5-year cash on the screen or with broker dealers in New York over the phone, and then I would have to do the futures on my electronic system. Well, I did this one trade in the 5-year, and it happened to be one of my bigger trades that I was doing at the time. And this was probably about a year in or so, and I needed to sell 500 5-year futures, which at the time was a lot, but it wasn't that big. I mean, the 5-year future was probably 1,500 up, but I hesitated. And back then on the Project Day system, you knew who was trading with you on every site. Every trader had an acronym. Every house had a clearing number. And back overnights, it was me and another guy at Gelber, I think, that would battle in the 5-year space. And I bought up this cash and needed to sell the 5-year futures, and I didn't get them. And his acronym came up, my adversary from Gelber, and I was so pissed. And I missed a 500 lot, which on every half tick that adds up to some decent money. It's $31.25 a tick, so $31.25. So that right there, and you never forget your bad beats or bad losses. And I think I had to pay down another quarter or half tick to get those. But that, when you lose that kind of money as a new trader, it's going to sting you, and it's going to, you look back and you're like, well, why did that happen? But in trading, if you hesitate even just that little bit, it's the difference of turning a winning trade into a loser. And, so that point, not that was a setback, but that was a reality check to how quickly something could look so good and turn so bad. So, I don't hesitate even to this day now. If I get, I'm putting it on immediately, just because you don't know what's going to happen in that split second. Even now, it's even faster. It's into the microseconds or whatever. But so that was an early lesson, for me to realize that you can turn something good into something bad relatively quickly. But let me think if there was anything else that happened that I could, just things like that. I think the biggest keys early on for me was taking losses. I was very good at taking losses quickly, like getting out of something, not having a string of losses. Obviously every trader goes through that, but getting out of something when it wasn't going the way that it was supposed to, or as expected. I think that made me a good trader as well, because I was very cognizant of my risk base and my risk capital. And I always looked at something like, if it took me more than a day to get back, and that was then I'm losing too much money. That's kind of how I looked at things. And I'm still the same trader today, even though the market's completely different, and the dynamics of the markets are completely different.
Yeah, of course. Now, you were at TransMarket for what was it? It was 12. Was it 12 years in total? I know you were there for quite a while. You left, came back.
Yeah, I was there from 96 to 2006, and then 2010 through 2011.
Okay. So for 8 of the years you worked at TransMarket, correct me if I'm wrong here, but you became one of their the biggest trader in terms of volume and in terms of performance.
I don't know if I was their biggest trader, but I was definitely one of their, in the bond 30-year space for sure, one of their larger traders, if not largest trader. At one point in time, I would do probably, I can't even tell you how many hundreds of million in a day. Even at one clip, I would do 50 to 100 million all at one shot. But the market allowed for that. Not always, because I do remember this one time I tried to buy 100 million. I got them, and it was stayed offered for like 200 more million. And I knew I was in trouble. So, But once again, I knew that I was wrong and I just got out of it. I knew I could make that back. That wasn't a big deal, but every market dynamic changes. So you have to change with the marketplace. But yeah, no, I was definitely probably one of, if not one of their largest 30-year basis traders there.
So how much capital did you start out with? Like, I'm just trying to get a bit of perspective around like where you started out and how you grew your capital to become one of the bigger traders there, like $50, $100 million at a time. Like that's no joke.
No, yeah. I mean, well, at the time the market, it allowed for it though. You got to realize you can't look at it in today's marketplace. So let's look at it back then. Let's just say it's 2003. I know I can sell or buy 1,000 bonds and I might not even move the market, depending on what locals are offered down there. Whereas you can't do that now, but back then you could do it. So to answer your question, I think the biggest thing for me was having not a set amount, but knowing when to say when. So like on a given day, if I made X amount, I don't even want to put a nominal number on it. I was done and it could be 9 a.m. and I would be, I would leave and some of the other traders would be like, well, you're not going to stay the whole day? I go, but no, what's the point? What am I going to squeeze out of this for the next 5 hours while I've already made my money? The only thing I can do now between this and the close is lose money back. So that's kind of how I did it. Now, that's not how everyone was. I mean, obviously, there's a lot of guys that want to stick there and grind things out and watch it. Maybe something happens, maybe something doesn't. But I was very good on hitting my targets. And no matter if it was 7:45, 9:45, or whenever, I was done. And I would reevaluate for the next trade or the next time. And I would, generally go home flat, just for a clear head and clear conscience. Not always, because there was obviously in the bond there, like I said, there's repo situations or roll situations that you'd want to keep positions on. But I think what really turned the tide for me was building up a capital base so that you could actually take more risk and understand that you have the responsibility now. The success is riding on your shoulders of keeping this capital and growing this capital. Nothing more bugged me than like a debit or having some sort of debit, even on a trading day. That would annoy me. But you're not going to avoid those, right? You're going to have losing days and losing weeks and maybe even losing month, But generally, if you're a good trader, you should easily overcome those things and figure out how to overcome them and why and how to revamp your trading and retool it, as time goes on, because the market is dynamic and it's always changing. So the game is always changing. But yeah, just to answer your question, I think building the capital up to a point where, it allows you the comfortability of extending the risk in your trading. I think that was a big key for me.
Right. Yeah, it's interesting how you point out that if you reach a certain amount, you would call it quits for the day and leave it at that. Whereas some people those are the days where you really want to push harder and try and make it more. It's funny how everyone does things a bit differently.
Yes, for sure. And there's guys that were very good at that. But that was not my mentality. I didn't think that way. Now, that's not to say that they were wrong or I was right. It just wasn't for me. And I think that's another key thing that I try to install in people that are interested in trading is that everyone does everything differently. You can get from A to B in various ways, but they're going to be unique to you. Certainly there's styles you can emulate, but I often point out, after mentoring a bunch of traders, I can show two traders the same chart and they'll tell me to buy and one will tell me to buy, one will tell me to sell, because it's all based upon what our personal, background is, I think shapes you. I think what your personal experiences are, they shape you. It's trading's much akin to like a golf swing. It's very proprietary.
This episode of Chat with Traders is brought to you by Casper. Casper is an obsessively engineered mattress at a shockingly fair price. Casper's supportive memory foam creates an award-winning sleep surface with just the right sink and just the right bounce. I feel as though I should almost add a Goldilocks joke in here, but I'm clearly not witty enough. But here's the thing you need to know. You can try Casper for 100 nights, risk-free, in your own home. And if you're not feeling it, for whatever reason, they'll come along, pick it up, chuck it in the back of a truck, and take it away. And they will refund you everything. Because Casper agree that you should get to truly sleep on a mattress before you commit. You should also note, Casper do free shipping and returns for every single person in the US and Canada. And if you look online, you'll see something pretty impressive. Casper has over 20,000 reviews. Yes, 20,000 reviews with a 4.8 star average. Okay? Now, as a special offer to you, I'd like you to have $50 towards the purchase of any Casper mattress. Just visit casper.com/chat and use the offer code CHAT. Okay? Visit casper.com/chat and use the offer code CHAT to save $50 on the purchase of any Casper mattress. T's and C's apply. Now, I don't want to gloss over the fact that you were at TransMarket and you came up under the guidance of Ray Carman, because he's considered a bit of a legend there in Chicago and probably further widespread than there. But, you know, one of the things you said that he really tried to push upon you was the willingness to take risk and build up your risk tolerance. Was there anything else which he tried to get across to you? Because, you know, when I think about even some of the traders who I've had on this podcast, when I see one of their names, I instantly think about a certain something they said. Like, they had this particular thing. It was something that they were really big on. Obviously, Ray Carman was very big on taking risk. Was there anything else he was really big on?
He called risk stuff. It was always this weird word, like put on some stuff. And no matter what it was, he just wanted to be involved in the marketplace. I think one of the biggest takeaways is, you know, he's like a racehorse, right? I think he's still in the game now, to be honest. But I think what I saw early on was his passion for it. And I think that I thought I had a passion for it, but I really, until working at TransMarket, really couldn't grow that. And you really get involved with the dynamics of whatever it is you're trading. My focus was obviously the fixed income 30-year, 10-year, 5-year sector, but other people obviously trade other things. But I think one of the things that I got from him was his passion. He was so passionate about it, and he was so passionate on not only trying to drive you to be passionate about it, but making you figure out whether or not this was for you. He felt like that. I think he knew right away whether or not you were cut out for it, but he didn't want to say that to anybody. I mean, obviously, as you get to know him better and you get to, you know, people could take him. He was kind of an eccentric, so he comes at you from all different angles, and I think a lot of people were very intimidated by him, including me, being a young guy there. But as I got to know him, you know, we kind of build this working relationship, and you know, so I felt I can talk openly with him. You know, I could disagree with him, where other guys I think they never wanted to disagree with Ray. You know, basically because, you know, it's Ray. You know, so where I kind of took a different route. You know, I listened to a lot of what he had to say and take it all in, but formulate my own opinion. You know, I wasn't like I don't want to say a greasy wheel, but I definitely would let him know as our relationship grew whether or not I disagreed with him or agreed with him. But I think when you talk about, when you want to say one word for like another, when you hear their name, passion definitely is Ray Carman. There's no doubt about that. And he's very genuine. He's genuine. Like, he wants you to succeed, even though, you know, you might not know that. He definitely wanted his guys to succeed and be the best at whatever they were doing. That's for sure. That's
the sort of person you want leading the team.
Yeah, no, for sure. And like I said, maybe, you know, it's hard to describe the way he would come off. You wouldn't know where he was coming from, basically. But I knew there was a genuineness behind him in trying to install the passion into any one of his traders. And that's what really resonated with me.
Have you seen that photo of Ray online where he's sitting on the side of his bed and he's got 6 monitors on a rig that's on a big swing arm mounted to the wall that swings over, and he can just sit in bed and have 6 monitors up in front of him?
Well, you know, it was a lot of the guys. Now, Ray, he ran not only I don't think he ran the cash side per se, but he was more in charge of the yield curve futures guys. He was part of the cash group. Obviously, TransMarket Group was his company, but he would basically have interns work for him and have to go to his house and watch his screens and do all that. But I thankfully didn't have to do that. I was one that didn't have to do the internship with Raycom, and I was lucky enough to just work under Mark and Jeff and just hear about all the good stories of Ray yelling at you because you didn't press a button or do something else. But yeah, I saw that one. That was kind of funny. I think that was like in the mid 2000s or something that came out.
Yeah, that's incredible. I'll dig up a link to that photo. I'll stick it in the show notes. So if anyone listening wants to see that and really see what passion looks like.
Yeah, no, for sure. Well, I know you could see there's probably another photo online of him. He got into some biking because he likes to ride his bike into the work a lot. And I know somebody cut him off one time. He got all bruised up, came in, he was all cut up, and I think somebody snapped a picture of him or something. But yeah, that's the type of passion he has. He's got all this and he's still biking to work.
Yeah. So what happened after you left TransMarket? Tell us a little bit about your experience at some of the other places you've traded for.
So yeah, then I tried to go into the fixed income arbitrage space as a CTA, which is a commodity trading advisor. So I went off on my own in 2007, and it took me about 2 years to get the CTA designation, which I did. I passed all the FINRA and all the CFTC stuff to do that, but just had a hell of a time raising capital. You know, obviously it was a 2008 crisis back then and 2009, and everybody was on edge about where to put money and where to put capital. So I spent a ton of my money on trying to build that, and actually it ended up being costing me a lot more money than I thought. So then I'm like, you know, I got to continue to trade and try to manage a business. I can't do both, really. So that's when I gave that up and went back to TransMarket Group. And then I only stayed there for another year and a half because they decided to change routes from the discretionary trader to the more algorithmic high frequency side. And I didn't really want to be a part of that. I never felt that high frequency trade was my bread and butter. Mine was more of a relative value historical context trading, and which is somewhat systematic, you know, but still I like the discretionary aspect of it. So I had to part ways from there, which was, you know, it wasn't a big deal. That was fine. And then I took a job which was based in New York. And my job was to hire 5 or 6 traders and get them involved into fixed income arbitrage, which was the system that I had. So I spent 2 years building that out. Things went relatively well, except we couldn't raise the capital once again from their external hedge funds to back the trade even bigger, because it got to the point where you can either increase our trade and spend the money on technology, or kind of just keep it the way it is. But that's not. I don't need a company to back me for that kind of trading. You know, it wasn't what I was, let's just say, promised to be, as opposed to, you know, where I thought it could be if we spent the money and did it. But, you know, it never got to that point. So.
Okay. So what's your situation today?
Oh, so now I still have Agne asset, which I trade my relative value basis through. And I'm building basically a 4-year track record to open my own hedge fund. It's still viable, still makes money, still does everything that I think it can do. And I'm right now in the process of just banging away at the monthly track record to, you know, hopefully attain enough capital to start a hedge fund, which, you know, probably takes $25 to $50 million to do in today's market.
So why the 4-year track record? Is that just a good number?
Everybody I've talked to, they like the trading, they like the track record. But it's a matter of, you know, how viable is it through different trading environments. So like, how did you do through, you know, not that they'll use 2008 as an example, because that's, you know, 8 years ago, but, you know, some guys might want that. But it seems to me like the bigger capital wants at least 3 to 4, if not 5 years worth of actual real trading track record. At least that's from what I've been, you know, accustomed to seeing. You know, now I don't have the connections at Goldman Sachs or those guys to say where I've come from, you know, Yale or Harvard. I could just, you know, call a couple connections. I don't have that. So it's more of like, you know, work your way in, show that it's viable in actuality, you know, give them your statements, that kind of stuff, and then they'll listen to you.
Okay. And are you thinking more along the lines of a hedge fund structure or more of a CTA structure?
Yeah, no, I can't go the CTA route because of the U.S. Treasury cash. It seems too tough to having things if they're not underneath one roof, let's say. Here in the U.S., you can't trade U.S. Treasury cash and clear futures under the same roof. And then to take it to investors, it becomes very difficult for somebody to raise money for that, because now you got to house money in both whoever's clearing your cash, whatever investment bank is clearing your cash, and then you got to house capital in your futures clearing merchant. So you're putting up two fronts of margin capital for one actual trade. And with all the new Frank Dodd rules, they put everybody in the same category, whether you're trying to make $100,000 a year or $1 billion a year. You're the same trader. So in effect, you need I think the lowest amount you can have to offer this as like an investment is like 45 million or something. So there's rules and regulations that are a little bit of a deterrent, and just the niche side of it that it is. Now, if it was just futures and options that I was doing, I could do that CTA all day long, but that's not my trade. So I can't do it that way. I have to, abide by the rules and regs and market it, or not even market it. I don't want to use that word. It's until you get to that point where you have that minimum set of capital, I feel that it's not going to be viable.
Yeah. Yeah. And what is it about going the hedge fund route which is appealing to you?
I just know that this trade is highly scalable. I know a lot of people don't do it, and I know that the track record is viable. I've done it. I think there's a lot of, false prophets out there in this money management world that claim that they can do certain things and, that they probably can't. So a lot of guys get into this business, let's say hedge fund or money management. They're in it for the fees. You raise 100 million. Yeah. 2 and 20, you can take 2 million home. I'm not in it for that. I'm in it because I know what I do is viable, and there's still a niche market for it. And, I think I could bring that to a lot of people that don't understand it. So I view money or capital, in terms of fee structure, is a byproduct of the success I would have in terms of delivering, alpha generation in a non-correlated way too. That's the thing about my trade. I'll make money whether or not the equity market goes up or down, or if the bond market goes up or down. I don't really care what direction it goes in, and I think that's advantageous to a lot of risk-averse players.
Yeah, well, I'm really keen to hear a bit more about your strategy, but I think before we do, a good primer to that might be just to talk about the Treasury bond market in general, and then we can maybe focus in a little more on your strategy.
Sure.
You're obviously the right person to ask about this, considering you've been trading it for however long now. It's not something we've really covered on the podcast before, in great depth at least. So I guess a few of these questions might be somewhat basic or sort of beginner questions, but I think it might be really helpful for many people listening. I'm going to assume that a lot of listeners don't know much about this market. I'm also going to put myself in with that bunch. I mean, I know next to nothing. So, let me just ask you, why do you trade the Treasury bond market? Is it just what you've always done, or is there a specific reason for why you like this type of market?
Well, I think, that's a big part of it. I mean, that's at TransMarket, that's what we were known for. So realistically, most of my exposure was to this market. So not only the futures side, but the cash side, which a very few people actually traded outside of, investment banks or banking sector players. But our proprietary group traded it. And I've always felt that was, it was kind of a cool club to get into. So the bond market, it's very big. It's very, it's larger than the equity market. You've got varying degrees of interest rate risk, duration risk. When I speak of duration, we could let's just say 1 year T-bills to 30-year bonds. You've got a long time frame in between there. And with those time frames, there's certain variance of interest rate and yield curve risk. So I thought the dynamics of it were very, very interesting. So that's always been one of the reasons that drew me to it. There was a lot of variables to it, but that I don't want to say that this market, I do trade other things. The fixed income market is my primary market, but I do trade index, S&P index, and sometimes the euro currency in those. But the fixed income derivatives and the futures, options, and cash is my main market. Primarily, to answer your question, is because that's what TransMarket's big focus was.
Okay. And these days, what are you trading? Are you trading is it the 5 and 10 year?
Yeah, the 30-year. I mainly trade the 30-year and the 10-year cash against the futures. So that's when we talk about an arbitrage, it's taking one instrument, and let's say you're buying one instrument and you're selling another instrument, and you're just hoping for a variance in between the spread. It could cheapen or, get more expensive, and and you'll profit whether or not you're long or short that side of the spread. But I always tell people, when they talk about trading, you're a good trader, you can do this or do that. I'm like, no, that's not true. Cause I'm not a very good outright trader. I can't buy or sell bonds outright and do well. I don't think I was ever good at that. If I bought it, I guarantee it goes down. But if I do my spreads, I'm much more comfortable. So maybe that's the thing linking it all together, is the comfortability. Because people will generally ask my opinion on rates and that kind of stuff. And I'll have my opinion. I'm very, I don't agree with what the Federal Reserve and the central banks are doing. And I don't agree with QE, and I don't agree with artificial props of financial markets. But that's the market we have. So it has changed my market somewhat, because the central banks are kind of like the main buyers and everything. But that doesn't mean you can't, the niche is still there. And I still think a lot of people don't understand it and don't do it, especially nowadays. You get a lot of these engineered physics programming types. They don't understand the dynamics, I don't think, of the players involved in this market. They're just looking at two binary numbers and trying to see, if it's a buy or sell based upon the parameters. But I could be totally wrong about that, but I would highly doubt they understand the dynamics of the basis.
So a couple things based on that. First one, when you talk about the cash and the futures markets, can you just explain how they differ? What's the cash market for and what's the futures market for, and why is there two markets there?
Okay, so the cash market is, when I talk about the cash market, I'm usually trading what's called the on the run, which is the most recently auctioned 10-year or 30-year, let's say. So they have quarterly refunding auctions, February, May, August, and November. And so when I talk about the cash market, that's usually the instrument I'm buying or selling. Now, you'll hear other guys that do off the runs or old issues, and those are just old issues that were on the run, but their time passed and now they're off the run. And then you talk about the futures market. The futures market's the derivative off of that, because it trades on, I don't want to get too far into the dynamics of the basis, because then you'll start talking about what's called the cheapest to deliver and conversion factors. And that's what basically drives the basis pricing. When you're buying and selling the cash instruments and buying or selling the futures, that's the basis. And what drives that are the dynamics of the cheapest to deliver, if there's an ability for that cheapest to deliver issue to switch. Sometimes the calendar roll could have an effect on it, even on the future side. So there's a lot of dynamics that go into that I don't want to complicate your listeners with. But there's a lot of factors that could, that make the basis very interesting. And that's what I've always liked about it, because it's every day is different.
And who are the major participants in bond markets?
Well, I think, obviously today the central banks, they own, I think, close to 40% of the entire float of all of them out there, but they're not in and out of the market every day. So you'll have, obviously the big high frequency guys that in there that, they might be doing some balance sheet stuff and keeping stuff on, but they might just go flat at the end of the day. So there's those type of players. There's obviously long-term insurers trying to match liabilities that are always in there, buying and selling based off of, their liability match and interest rate structure that they think is going to happen over the next course of whatever time duration they're trying to match. I think in today's market, it's primarily driven by high frequency groups that don't take balance sheet risks, that go flat at the end of each day. That drives the market and the pricing. And due to that, and due to some places being able to warehouse trades, that means they can net a buy and sell inside their own firm. I think that presents a little bit of a mismatch in the outright market that we see currently. That the one that is displayed on the screens, because you don't see the entire you don't see the entire, market being put out for sale or for bid. So I trade on secondary markets, that are done through, let's say, BrokerTech or NASDAQ OMX or TradeWeb or Bloomberg. Those are the guys that provide the pricing for the U.S. Treasury market. And then I'll do the futures through other separate systems, which I don't know if I should mention their names or not, but
I mean, if someone's interested, I guess they can reach out to you.
Yeah. Well, CQG will allow you to, as a trader for a third-party system, will allow you to have access to that market. CQG does it. Trading Technologies, TT does it. I think some of the other ones do too.
Oh, right. Okay. Because that's something I was going to ask you, actually. I mean, is for someone who's new, let's say someone's fairly new to trade and they're interested in potentially getting involved in the bond market, what barriers to entry are there?
Well, if you trade the cash, obviously the first one is capital with their new rules and regs. So like you're going to have to either get a proprietary job at some firm that actually offers it, or get a partnership and enough capital and do it through that way, through another firm that has the balance sheet that can trade the U.S. cash. But if you're just talking about like fixed income futures and options, it's fairly easy to get involved in that on the, like I said, either through any FCM and whatever third-party vendor system you want. I think anybody offers that. And not only just the CQG or TT that I mentioned, but I think most of them offer access to it, to CBOT products. It's the cash market that's the real issue. It's I don't even know how you would get involved in that as a beginner now, to be honest. I don't even want to answer that clearly. Other than going to get a job at a prop group that already trades basis, something like that.
Okay. Well, let's leave that for now. What about ETFs? Because there's a lot of ETFs which are kind of spin-offs of different bond markets.
Yeah. Like the TLT and the IEF, those guys. Yeah.
Yeah. So you think they're a fairly reasonable.
Oh, in terms of participants? Yeah, definitely. I'm sorry I didn't mention that. I'm glad you brought that up. No, for sure. They're definitely a decent player in there now because of the size of them. But once again, I don't know if they're actively involved in there. They're probably just matching their NAV at the end of the day and adding or subtracting whatever their mix is at that point. I don't think they're actively, buying or selling the issues throughout the day. And once again, you might get an ETF expert on here that manages those. You might disagree, but and maybe they do. Maybe they are. But I don't. The size of the market that trades on the secondary screen compared to what it was back in 2004 or 2005 or 2006 is nothing. It's minimal. And that's real. That's the real dynamic change of how our market or my market has changed is what you actually see on the screen compared to what you used to see. Back when I used to do 50 to 100 million in the 10-year, you'd be able to get those off on the screen. Now you can't really. You could probably get them, but you might move the market off of doing that. But as soon as the algos sniff out you want to buy or sell 500 10-years, they're going to front run you.
So why has that changed so much? Just because of
because there isn't the integrity of the bid and offer is different. Once high frequency came involved in these markets, they could both simultaneously be the bid and the offer at the same time. Whereas back in the pit, you couldn't do that. If you were 5 bid and somebody said sold, however many he wanted, you better take. So whereas now, if I see 5 bid on a screen and let's say there's 500 there and I go to sell 500, I might get 100 of those. Because if I don't have my own black box model, proprietary software, and I'm using like a second party or third party vendor, they're going to see my order before my order gets filled. Now, some people will say that that's illegal or that no, it's just a time delay. I'm delayed. If you're on a third party system, you're delayed, whether it's 6 milliseconds, 7 milliseconds, whatever that delay is, it's not actually what's on your screen. So that was one of the issues I kind of had when I was at this place, was when we were doing bigger size, I would never get the size I would need, and somebody would always get them before me somehow. And that's when I knew right then and there, and this was like 2011, that's when I knew that the only way to increase size is to increase your speed as well simultaneously. So, which will take, technology and infrastructure, obviously. But a lot of my stuff now, so that's what turned me away from trying to, do things a certain way. Whereas now, I'm doing more, based on historical, based on relative value, and I'm putting the position on. I don't care if I buy the offer necessarily, because I'm viewing my trade setup as correct. And I'm hoping that if I buy the offer, it becomes the bid and somebody else will buy the next offer because of my analysis. So it kind of makes my trading skill set a little bit deeper and more involved. And, whereas execution is not my precursor to success. It's based upon how my system works and where it tells me there's value and where it tells me something's cheap or expensive, in that respect.
Yeah, that certainly makes sense. Just before we get into a little bit about your strategy, just one more newbie question around trading the bond market. Is it preferable, from a trader's standpoint, for traders new to bonds to maybe choose either the 5-year over the 10-year over the 30-year? Like, are there any big characteristic differences between the different Treasury bonds?
Yeah, there's more risk as you go further out the curve. So obviously there's more risk to a 30-year than there is to a 5-year. Not only because it's a longer holding period in the bond itself, but the price movement is larger. So the 5-year trades in a quarter tick increment, the 10-year trades in a half tick increment, and the 30-year trades in a full tick increment. So if you buy and sell one lot in the bond and you lose a tick, it's 31.25. Whereas if you go to the 10-year, it's half that. It's 15.6250. And if you go to the 5-year, it's down to a quarter tick. So if you're just starting out in the bond market, I would definitely start out more in the 5-year sector, probably futures wise, because it's quarter tick and it's a little safer. But most of the time, if you're starting out, you're probably a spreader of some sort. So you might want to spread like a 5-year against a 10-year, or even a 5-year against a 2-year. Something to you understand the dynamics of what moves these markets. And right now it's kind of sketchy because you've got a central bank that's raising rates, which should affect the short end and should flatten that out. But we've had just nothing but steepening over the last month. And even though they're raising rates, because, obviously everyone's calling the Fed's bluff, saying you can only raise so much, you're going to have to eventually roll back down. And that's why the yields on 10 years are still below 2.3%. So you got those dynamics, which makes it very difficult for somebody new coming out. There's a lot coming at you. It's not just like buying like Google and waiting for an earnings to come out, and which I didn't think went too well for them today. But there's a lot to the bond market that you're going to have to figure out if you're coming into it. Not only, you got to figure out, what drives what components of fixed pricing and floating pricing and bond duration and all that. There's a ton into it. So I don't want to complicate it though. I don't want to dissuade somebody. Let's just say, I think you should probably read up a little bit about the bond market before you get involved into it, I think. But I would definitely start out in the shorter end sector.
Well, are there any resources or any material online maybe which you think's particularly good?
The CME Group does a great job of providing free resources for any one of their markets. I think you could start out there for sure. I mean, there's so many, I think there's actually a few interactive ones on there too. That go into delve into the pricing mechanisms of it and, that kind of stuff. I think the CME Group does a great job of that for sure. There's more than enough there for anyone to really want to dig into and, learn more about it. Because bonds are tough to a little bit understand, because they have a yield component to it. And if bonds are going up, yields are going down. So sometimes people have a hard time figuring out, well, yields are falling, that's good, if you're long, but because it's counterintuitive, something falling is good, So it's strange if you don't have any exposure to it once you're, getting into it. There's a few dynamics, things that you got to kind of figure out first.
Okay. Well, I mean, that sounds like a good starting point anyway for anyone who's interested. So, Mike, let's focus a little more on your strategy. So you've described your strategy as a relative value strategy. Can you just break that down in simple terms? What does that mean?
Yeah. Here, let me just think. Try to explain it simple. So yeah, like relative value. So So I've got like historical pricing, on most of the bonds that I've traded for probably the last, 10 years. So through that, you build models on relationships on each one of the, different sectors. So let's just use 5-year, 10-year, 30-year for that, this scenario. So now whether it's an interest rate hiking environment or, obviously we're in sort of a hike, but we're not, kind of thing. So you try to figure out how they reacted to a certain stimulus before and whether or not they're going to react the same way. And then what time frame are they going to react the same way? So when I talk of relative value, it's how is one performed relative to the other in a similar environment. Now it's not, obviously it's kind of like it sets the parameters for how I trade and it'll tell me whether or not something's rich or cheap, but that doesn't mean I always have to. This is the thing that's a little bit more dynamic than like just having a straight up black box model, I think, is that I will sometimes, not always discretionary, make a call whether or not I believe it or not. Sometimes it hurts me, sometimes it saves me, but I like to generally still have that control of whether or not I believe that based on historicals, based on this relationship that yes, this thing's telling me it's cheap, but I think it can get cheaper based upon what players are involved now, based upon how it's been going over the last day or two, how I feel, those are those dynamics that aren't necessarily built into it, but are something that I take the discretion of utilizing. So if that kind of makes sense, where I'm using historical relationships against the current backdrop of trying to figure out whether or not one bond is relatively cheap or expensive to another.
Okay, so if you had to say how it is that you generate alpha, I mean, how would you answer that?
I would say that my trading generally describes a certain trade setup as either rich or cheap, and if I'll take either side of that in hopes that over the course of, it could be hours or days, or for that instance, let's just use that for example, hours or days. And throughout that course, either the trade's going to go my way based upon this, or the dynamics are going to change and my system's going to say, well, now something that was cheap is now fairly valued, and it might be time to exit it. So then I'll exit, something like that. But it's not always, I'm not looking to take a half tick or a tick. It might, it might not say that it's overvalued for 2 or 3 ticks. So it'll allow me to hold something as well, as opposed to just taking the half tick or tick out of it and going flat, let's just say. It allows me to have a general idea of richness or cheapness. And that allows me the flexibility to stay in a trade or, decide to take it off and see if it's the signal is still there.
Right. So I guess this question may seem fairly simple on the surface, but it might also be quite a complex question in some ways. How do you determine what's cheap and what's overpriced?
Yeah, well, I mean, there's obviously the market will decide that, right? I'm not deciding that. My system's not necessarily deciding that. The market's deciding that. So I have the parameters set up, and like I said, it'll say whether or not today or at this time, based upon these parameters, it's rich or cheap. Now I can, like I said, the part of my stuff is discretionary, is whether or not I listen to it or not, and whether or not I feel like that this is correct. A lot of times it'll say like, okay, this is cheap, but I'll look at it and I'll look at, maybe how it's been trading over the last hour or two and be like, well, I think these guys are getting long still and it could get cheaper based upon, the days moving on, and these guys might be stuck. So I'm going to wait. And sometimes it works, sometimes it doesn't. Sometimes the cheap turns into 1 tick strong and then I miss it. But, I'm willing to take that in an overall sense of on a risk side and say, all right, let's just say I'll put 1 unit on here. And if these guys do have to bail, then I'm going to put another unit on, something like that. But I don't have a set exact parameter for that to say like, well, you should do, some people's systems are set up differently. They'll put 1 unit on here, 1 unit here, or whatever, however they set it up. Whereas mine, I try to keep a little bit more flexibility on it and use a little bit more discretion of how I feel the market's trading at any given point. I think that's what separates from what I do from a lot of the black box models that are always kind of, I don't want to say static, but just do things on a repetitious manner.
I guess maybe a different way of asking the question, maybe to get at a different part of it. What are the relationships you're looking at to help you determine relative value?
Oh, well, I mean, like I said, a lot of it's just based upon, historical occurrence and how one issue has reacted to another. Generally speaking, I guess a good way to describe it is if the Fed's in an interest rate hiking environment, the yield curve should roll down, roll over, or flatten, because obviously they're raising short rates, right? They can control the short rate. So when I mean short rates, I mean 0 to 2 years, let's just say. So if that's the rate they're raising, well, then obviously that rate has to rise. So normally they'll sell the front end, which is, like I said, the 0 to 2 year sector, and they're buying the longer end. So, but that doesn't mean that will always happen. Obviously, if we're in this environment, my system will obviously say the 2 years are expensive and, relative to 30 year. But you got to look at from a contextual point of view at that given moment, because this environment that we're in today, people, I think, are now realizing that interest rate hikes are easing. They're not a hiking of rates the way they used to be, because now we pay interest on excess reserves. So every time the Fed hikes rates, they're not raising, conditions of borrowing. They're actually lessening the condition, because they're paying the banks, $30 billion a year in free money. So the higher the interest rate goes, the more money the banks get. That's an easing of conditions. That's not making, conditions harder. So that's why I think everyone's off guard here. And I think that's why everyone, I think in the last month they bought the yield curve, because they realize that hiking rates is no longer what it used to mean. The conditions aren't tightening. They're actually giving the banking system more money. So when you talk about my thing, yeah, obviously it'll say in a hiking rate environment that just on a general sense, now Aaron, I'm being very generalistic. You should own 30 years over 2 years, but I know that hiking doesn't mean what it used to mean. So I generally would say that we should steepen, not flatten. And you can make money off of that, because obviously every big player out there looks at that. If you look at your big insurers that have their PhD economists out there saying, oh, look at the curve's going to flatten out and rates are going to be past 3 or 4%. I've been hearing that for 10 years now. It's not going to happen. This market, this debt can only go higher, and the interest rates can only move lower because of the mathematics behind what they've created. So they have to jawbone and talk a big game, when in reality, I know they can't raise rates the way they used to.
Well, we're talking about some pretty big picture stuff here. I'm just curious, what's the average duration of your trades?
You mean now? Okay, so in my world, duration, it could mean, am I trading a 30-year bond or a 5-year, or do you mean how long do I hold it?
Exactly. How long are you holding for?
1 day. 1 day generally.
Okay.
1 day.
So how do these big picture... Like you're very interested, and you place a lot of emphasis on understanding the fundamentals of this market as well, and economic influences. How does that affect your short-term trading? Because one day to the next can not necessarily be in line with.
For sure. Yeah. Sometimes it doesn't, sometimes it jades my long-term view, sometimes jades my short-term approach. And that's where I got to balance it, because I generally want to know where things are going in the long run, but it might not be the case in the short run. So how do I structure the trade accordingly? That's why when I say interest rates are, in my opinion, should move lower, but they may pop, because you've got a lot of big players out there with a lot of smarter guys than me out there saying that interest rates are going to rise, and they're going to put their money on that. So I can't fight that. If PIMCO or Double Line or those guys are in the market saying the rates are going to move up. But for what I do, I'm not necessarily, my holding period is so short that I'm mindful of the long-term fundamental reason and where I believe things are going to be. But I know in the short term, the market can trade anywhere. It's one of those things that, like back in the TransMarket days, I know, just because I have this belief doesn't mean the market can't go there. And that's why I kind of take over my relative value, because it'll tell me one thing, but I might not believe in it, So, but I have to really convince myself of why I don't believe something is rich or cheap. But you're right. I think it keeps me knowing or at least having a opinion allows me the flexibility of at least keeping a general idea of whether or not I want to be long or short. And I think from what you're trying to say is how, does that dissuade me on a short-term level of putting something on? And the answer is yes, it probably does. And a lot of times it does save me, but some of the times it does hurt me from actually putting on a trade that, even though I think yields are falling, yields might pop. So I'm not gonna be long yield or shorted in price, let's just say, because I still believe bond prices are going higher, so I won't sell it. So a lot of times, it does affect, whether or not I put a trade on or not. But more too often than not, I'm putting something on. And, that's the good thing about spreads is, you're just hoping the variance in one or the other moves faster than the other. You can always get out and reevaluate. And that's the good thing, too, that I don't get married to this stuff. I can always get out and get back in. I've got no problem of, let's just say selling threes and then buying threes back, just as an example.
Well, Mike, the one last thing I'd like to ask you about, and it's not necessarily directly related to your strategy, but just in general. I know there's a certain line that I don't know if you live by it, but it's something that you quote from time to time, and you say, if you take care of the short term, the long term will take care of itself. Do you mind just expanding on why you use this as a mantra?
I think once again, that goes to my TransMarket days of growing up and having to generate capital before you took on a lot of risk. It always seemed like, and also going back to where if I made my net goal for the day and it was 7:45 in the morning, I was done, because I felt like on a mental level in this game, in this arena, if you're not at your best, if you're not at your cleanest mental state, I think you're putting yourself at a huge disadvantage. So I always felt I traded better, that if I always took care of the short term, which was like, I'm done for the day, then I know tomorrow I'm going to start out fresh. I'm not going to have an opinion necessarily, and I'll have a clear conscience of what I need to do. And, obviously the goal of a trader is to make money. I don't care what market you're trading, what are you trading, or whatever you're investing in. Nobody likes to take losses. And I think the hardest thing to do is to take a loss. And I think it's much easier to do on a clear conscience than it is, otherwise. And, I think that's just one of those things that I've learned from the beginning, and that's always stayed with me. And so I figured, that mantra of always taking care of the short term, it's conservative, but in the world of trading, sometimes conservative kind of buys you longevity, and it allows you the dynamics of, altering your trading state through as the market changes, because, today's market's not the market as it was 10 years ago. And that's hard for a lot of people to adjust to. I've mentored a lot of traders, and I've seen a lot of, different backgrounds, different, guys come from money, guys that don't come from money, guys that, had a great education, guys that didn't. And I don't really think much of that matters. I think I think the trading skill is innate, and it's very proprietary to the nature of the person. And I think understanding yourself is one of the biggest facets of success, I think, in this arena.
Well, on that note, let's wrap things up here. So Neil, who introduced us and who was also on, I think it was episode 127, who spoke about starting a CTA, a commodity trading advisor, how you would go about that. I presume we're allowed to speak about this, but you ghostwrite their newsletter.
Yes.
Now, Neil asked what she do. She set up a page so that if anyone wants to get that newsletter, which you, Mike, write, you can do so. So I'll set up that link. If you go chatwithtraders.com/Mike, M-I-K-E, that'll redirect you to a page where you can actually subscribe to a free newsletter that goes out. I think it's once a week, where Mike, well, you tell them what's in the newsletter, Mike.
Yeah, well, we try to speak about, obviously I cover mostly bond and equity stuff, futures, cash, options types of trading. But I also like to cover, whatever happens on a global macro environment. The goal of it is to educate not only CTG's clients, but anybody that reads the newsletter on other things that are out there in the alternative investing space. So, it's really more of an educational tool as much as it is like an informative tool on trading, let's just say. But my idea is to bring what the research that I do in my own trading and, out to anybody that's willing to read it, and I try not to get too highly specialized. I try not to inundate people with anything that they probably couldn't understand, even if they're coming outside of the financial arena. So my goal is to actually educate people on understanding the current marketplace, why things move, how it might affect you and your investing, and understand that there's a bigger picture in what's going on here, and try to provide some clarity in understanding these markets. Especially nowadays, Aaron, with everyone calling these things a bubble, and this is a bubble, and that equities are a bubble, bonds are in a bubble, and Bitcoin's in a bubble. I go, it's crazy to say these things because we really don't know how long things can last, and we don't unless we get underneath the hood and see what's driving the pricing of stuff. Then we can understand it. And if we kind of, collaborate and send these ideas out there, and people are free to comment or to send in something, if they want something to, be looked at, then I'd be willing to write about it for sure. Because I'm all in for the collaborative effect of spreading knowledge to people, not only in the trading environment, but investing in global economics as well.
I mean, I certainly encourage anyone who's interested in that type of thing to join up.
And it's free.
Yeah, it's free once a week. Quality research. No, it's really good, man. I've read several editions of it.
Oh, thank you.
You're also on Twitter, and I think do you have a website of your own or a blog of your own which you'd like to mention?
I do, put the stuff I ghostwrite for Capital Trading Group on there a couple weeks after I put it on my own blog, which is econemotions.com. So you can find it on there as well. If you don't want to sign up for it, I usually put it up there later on, a couple weeks after. So I'm doing that, and that's the blog. And then I'm on Twitter as well. Yeah, basis arb at Magni1313.
That's not your handle though, is it? It's just Agne1313.
Is that how you?
Yeah.
Is it?
Yeah, it is.
So you'll have to edit that out, Aaron. So what does it come up as? I don't even know, actually.
So your name is Basis Arb, but your actual handle where people can find you is at...
Oh, it's at Magni1313.
Yeah. So Agne1313.
Okay, so maybe you could send that. So you could say that part then.
Yeah. Just did. There we go. So and just a reminder, if you want to get the free research, chatwithtraders.com/Mike. That'll redirect you to Capital Trading Group page where you can get the free newsletter. So let's close it out here. Mike, thank you for coming on the podcast. Absolute pleasure to speak with you again. I appreciate it, man.
All right, thanks so much, Aaron. Appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.